In this video, I'm going to outline my exact thought process on what I would do if I was starting to invest in 2026, why I would invest, where I would put the money, what I would buy, and for how long, just absolutely everything. I make this video every year because understandably new investors look for information that is relevant to that period of time. If you're starting out, the tendency is to think you don't want last year's info. I'll be putting a fresh spin on this, but I also need you to understand that the trick to investing well is a plan that can carry you for decades, not one that changes every single year. So I'm about to outline what I would do if I started investing today, and it's how I actually invest today, and it's pretty much how I will invest until the day I die. Please understand that this video should not be seen as financial advice. I'm not your financial advisor. This is me just discussing what I would do. Please do your own research and also understand when you invest, your capital is at risk. The value of your investments can go up and down. To answer the question of why we should invest, let me introduce you to a 20-year-old version of yourself. At that point in your life, you are about to enter the workforce and start that typical 35 to 40-year process of exchanging your time for money. Some of that money you use to live right now, but some of it needs to be an allocation of money that you save for that day at the end of this journey, the inevitable point that you can no longer work. That is, of course, a pretty broadly understood reason for why we should save, but I want to take it a little bit further because where should we save that money? Would you just stick it in cash under your bed for decades? That is a bad idea. According to the Bank of England's official calculator, you would need about $51 today to buy what you could get with $30 in 2007. That is an increase of 70% in the amount that you need to do the exact same thing in around 18 or 19 years. Ladies and gentlemen, that is the effect of inflation, and it's the single biggest reason that you need to invest your money. 50 years ago, 30 would get you what 235 gets you today, and 100 years ago, 30 quid is the same as 150 to 90. We could just keep playing this game. So on our journey of a working career, there is this persistent force all of the time taking chunks out of the money that we earn, removing its purchasing power. If I just hold my savings in cash, stuff them under the mattress, and generate no return, that inflation would whittle away the value of that money. Now, there are times when cash is great, and we'll look at that later when we discuss time frames and how we decide where we put our money. But long-term inflation just eats cash alive. So we need a place to put it that has a long track record of beating inflation. There is a book that I consider the stock market return Bible. It stretches back 125 years looking at global stock market returns. It is hundreds of pages of analysis, but right at the start, they say something that's really relevant. When we're talking about inflation, stocks should be seen as excellent inflation beaters. But what about other investments that could potentially outrun inflation, such as property or even crypto? The reason I believe that beginners should start with the stock market and that it should be the core foundation really of anyone's portfolio, besides the inflation thing, comes down to three other points. First, the barrier to entry is low. You can start today with as little as $1 or £1. Try doing that with a house investment. Next is the track record. The global stock market has over 100 years of proven returns of delivering long-term for investors. And the whole thing with crypto is, yes, it has delivered good returns over a measured period. It's been a hell of a bumpy ride, but it's still pretty new. Bitcoin is not that old. Have an allocation if you like, but why ignore more proven approaches when it comes to something like long-term retirement planning or investing for your future over decades? I also just think that the stock market is a great introduction to the ideas of investing, producing returns, compounding, risk, and reward. And then later on down the line, you might engage in something that's a bit more spicy and volatile, like crypto if you want. The final point is the ability to protect your investments from taxation. And this is a big one. In many parts of the Western world, there exist tax-efficient accounts. I would personally make sure that I was using up the allowances on these accounts before I invested money anywhere else where it might be taxed. Avoiding tax on things like crypto or property is not an easy thing to do. Now, which investments would you choose? If I could go back in time to 2010 and ask myself what to invest in, I would of course say, with the benefit of hindsight, that you should probably go pretty heavy on the big American tech companies. The funny thing is, the past version of me might doubt that logic. That was a time before smartphones really dominated our lives. Why so much buzz about yet another personal device? It was a time when sentiment towards the American stock market was actually pretty poor. If we take a look at some of the weakness in the marketplace, it is growing here today. From 2000 to 2010, the US stock market had gone through what's often called a lost decade. It had been hit by the dot-com crash and then the financial crisis, and over that 10-year period, it delivered negative annualized returns. That had only happened once before, during the Great Depression. So standing there in about 2009 or 2010, it was far from obvious that America was about to go on the longest bull run in history. What I'm getting at really is it's not that easy to predict the future. There is a chart that shows the relative dominance of global stock markets over time that makes this point far better than I ever could. This table is in many ways the story of the modern world going all the way back to 1899. In 1899, this was a time when the UK was the global superpower, where it was also the financial capital of the world, and its currency was the global reserve currency. I challenge you to stand in London in 1899 and bet against the UK being the dominant force for the next 100 years. Or how about the period from the 70s, where Japan was killing it and America was faltering? Japan's astounding economic growth was famously known as the Japanese miracle. Parts of New York in the 70s were struggling with crime and instability. So if you were there at the time looking at Japan, would you have gone all in on America and bet against Japan? And yet look what happened next. I might think I can see the picture clearly, that the future is obvious, but history tells me that is not often the case. History tells me that the only thing that is certain is uncertainty. We live in crazy times, don't we? I don't want to dismiss the uncertainty of the situations that we find ourselves in today. Who knows what will happen? But the last few years have been crazy times. So was the financial crisis. The Cold War was a crazy time. History is littered with crazy times, totally unique scenarios. But the world has kept turning. And the best thing is, despite all those rises and falls, all the winners and losers, if I had simply just bought all of it, I would have earned around 8% a year before inflation, or roughly 5% after it. So that's what I do. I buy a global index fund, a fund that tracks all of this at once. That means I buy as much of the global stock market as I possibly can, because I don't know what the future holds, and I'm comfortable admitting that. I have that humility to say I can't predict the future, because if I couldn't see the future clearly in 2009, what chance have I got of guessing the shifting dynamics of the global economic stage now? Now let's look at how I would actually do that. There are funds that look to track the global stock market. One example is the Vanguard All-World Fund. This one investment gets you that global exposure. If I stick $100 in this, it then gets spread across thousands of different companies across approximately 50 countries all over the world. Different funds will track different versions of the global stock market, so they may include more or less countries, or they may only include big companies. Some funds will include big and medium companies. Some funds will include big, medium, and small. I obviously can't go through every single type of fund and show you them all, but I can appreciate that a big barrier to getting started with this is wondering, what the hell does all this mean and which fund should I choose? If all of that is too confusing and you're unsure, or you're just not confident yet in picking your own fund, there are services out there, so-called robo-advisors or managed services, that can do it for you. I know many people get started using these services, but I personally don't love these robo-advisors because I think they charge relatively high fees to do something that with a little bit of effort can be quite simple. Most of them behind the scenes are just buying global funds, globally diversified portfolios anyway, and charging a premium for it. If they made the effort to actually teach their customer base how to do this, their business model would just evaporate instantly. So I think there's a bit of a conflict there. I want to talk about the long-term effort now. I want to talk about what happens next. How do you decide what money you should be putting into the stock market? All forms of saving and investment should be based around a goal attached to a time frame with a specific amount. I want $1,000 for a bike in 12 months. I want $15,000 for a wedding in 4 years. I want to retire at 60 with $40,000 a year in income. That time frame then really dictates where you put the money in terms of what type of savings products or investments. Then the question isn't how do I make as much money as possible? It's what type of savings and investments product gives me the best chance of hitting my goal in the time frame that I need it. Let me break this down. If we look at the distribution of returns over time, over short periods of time, like 1 year, the average return for stocks is high, but the range of outcomes is massive. Many people who invest in the stock market for 1 year get results below zero. They lose money. Cash, on the other hand, has a much tighter spread of potential returns. That is the benefit of cash, really. You know that a $5 note will still be a $5 note tomorrow. So over short periods of time, like say a year, that certainty of the on-paper value really lends itself well to hitting short-term savings goals where you need a fixed amount in a short period of time, like buying a bike or saving for a wedding. Imagine if it came to your wedding day and you turn up and you go, yeah, I'm sorry, I can't pay for the wedding because the stock market's having a bad day today. But where the stock market really becomes attractive is over longer time horizons. If we look at a 10-year timeline, the average return is higher than that offered by cash or bonds, but the spread of outcomes has tightened. Essentially, anyone holding the global stock market for 10 years historically produced a positive return. And for savings goals of 10 years plus, the stock market gives the best chance of producing the most money versus, say, cash or bonds. The stock market is an amazing long-term wealth builder, but a really poor short-term money protector. So any money that I invest in the stock market, I do so with the understanding that it's been tucked away for 10 plus years. And then for short-term goals, I rely on things with more certainty, like a high-interest savings account. The final thing I want to do is I want to show you what that 10 years might feel like because it can get pretty spicy. Looking at the performance of the global stock market since 1979, the global stock market is a ride you wanted to be on over this period. Exceptional returns for long-term investors, but then here's what that period looks like year by year. There's way more green years than red, yes, but the red are there, so these are not just occasional events. They are very common. Statistically speaking, if you invest for 4 years, one of them will be negative. So over an investing timeline of 10 years, you might expect 2 or 3 of those years to be in the red, but sometimes you get 10 years of no red, and then 3 years all declines, which really tests your mettle. Now, it gets even worse when we look at the monthly data of the 563 months across this timeline, 198, were months where the stock market was falling. And if we look at all of the times in those years where the global stock market had dropped in value from its previous peak, it is basically every year. Isn't it crazy that this level of volatility produces those long-term results? This is why being in the stock market for short periods of time is so risky due to how common declines in value are. If you don't think you can handle those declines, this might not be for you because those declines are the ride that you have to stomach to get the prize that you're after at the end. Look, when it comes to investing, I can't make any promises to you. I can't tell you what markets will do or where the world is going to head in the medium to long term, which countries will win and what companies will fail. But the method of investing that I have outlined today hopefully looks to address some of that uncertainty the best it can. But the one thing I can promise you is if you think you can stomach this ride in 17 years, you might be sat there reflecting on the decades of life that you're about to live, and you'll just be thankful that this version of yourself got started. I'm Zuhair, and I'll see you in the next one.